Brian Lockett. I'm the lead advisor here at Comprehensive Wealth Management. Welcome to Fall 2024 Market Outlook. Hard to believe that we're just right around the corner from 2025. So with me today, as always, is Morgan Arford, and the unfamiliar face is Meghan Colarusso, who flew all the way out from New Jersey, correct?
That's
to
right.
come see our clients. By the way, that room in the background, that is our conference room, completely revamped. So next time you guys come in for a meeting, you'll see how lovely it is now.
The green screen conference room?
That's right, exactly. Don't look behind the curtain. All right, so today's agenda, you guys are looking at the list. Everyone here has seen this before. We're going to review a lot of information in a little bit of time. So we're going to go over the brief CWM commentary, brief I say sarcastically. We're going to go over Morgan's model and data review, the elections impact. I think that's what everyone wants to talk about today. And then we're really going to talk about something that no one's really paying attention to, and that is monetary policy and the potential return of high inflation. And after that, we're going to switch presentations and we're going to kick it over to Meghan so she can take us through BlackRock's perspective on the markets.
All right. Well, thanks, Brian. So as Brian mentioned, we will, of course, take questions. For us, it'll be at the end because I do want to make sure we get to our key speaker today. So I'm going to try to get through a lot in as short a time as possible. Where I always love starting on these, as most of you have been around a while know, is talking about you and thinking about where you are in your own life cycle. What we have here at CWM is several different strategies that are designed primarily for either when you're getting started, which is your typical buy and hold indexing strategies, your middle of the road strategies where you can say that I have something to protect, but I still need to grow. So we can't afford to be too risk off or too risk on, or we have what we call our risk adjusting models, which are the strategies that most of our clients are in, which are really designed for people in that retired space who are living off the resources where, protecting that downside is significantly more important than upside participation. We're not going to have time to go through each one of these in detail, but I do want to mention that these are here because we're frequently having conversations with clients now about maybe having a blended strategy. Even though our indexing option is really geared more towards, emerging professionals, people maybe who just got out of college and have a really high paying job, but low account balance. This is available to anybody who wants it. We believe in that more passive style of investing. We also have strategies here in the middle, the tactical allocation model and global allocation model, that is geared for folks who do have some preservation need, but really still want to prioritize growth. So they're a little bit more biased towards aggressiveness than the risk adjusting models are. If one of those is interesting to you, or you become interested throughout this presentation to learn more about that, please make a meeting time with Brian or one of the other advisors after the call today.
Well, and I want to chime in before you move on there, Morgan, and really say we've been having this conversation as clients have been coming in for their review meeting about this concept of blending strategies. Because one of the things, we're always researching that we have observed is no single strategy works in all markets. For example, if you look at the bookends here, the risk adjusting model, RAM, we came up with some really creative names here and we want to be consistent. And then WHAM, okay? If you look at the last 5 years, they've literally traded years as to who's been the better performer, which is kind of interesting. And so what we're finding is by blending these strategies, it's really smoothing out the ride. Now, if you want to learn more about these strategies, we're happy to chat about it. But if you want to go and watch the video that we did, which I'm sure you do, that was in October of last year. And that's actually in our video archive on our website. But at the end of this session, we're going to have Kelsey's contact information. You can get a hold of us if you want to have this conversation proactively. Otherwise, we'll have this conversation when you come in for your review meeting.
Thank you, Brian. So continuing our conversation around, thinking about what kind of strategy might be right for you. Typically, you hear the argument of just buy the market, it goes up over the long run. The problem is that works really well for immortals, but not necessarily for mortal people, where the market can go sideways for extended periods of time. You really want to think about this because if you graduate from college in 1929, maybe you get a good paying job, you don't get laid off in the Great Depression, but you're saving and investing all the way through this dollar cost averaging into the market. That is a great time frame to be an investor by the time you get back to break even. If you're living off your resources, you retire in that same year, this means you go broke before you get back to break even. This is a big concern. Again, where you are in your lifespan really matters as far as strategy selection. Also your behavior, also your own personal desires. These are the things you work on with your financial advisor. When we look at the market throughout history, what we notice is on average, it makes about 10% a year positive. In order to get that 10% positive outcome, you have to suffer drawdowns every single year. All these red dots, that's the worst top to bottom sell-off in each one of those individual years. The average drawdown every year is about 14%. To put that into dollar terms, if you have $1 million portfolio, that is a $140,000 loss at least once every single year. If you're going to be an investor and you're going to try for that long-term positive outcome, you have to have some tolerance of downside participation. You have to just hold through it. I have a joke around here called the magical 3%, where that's about the level, a 3% drop, where clients start calling us concerned about portfolios, which is totally fine. But I just know it's coming every single time. Oh, we're 3% off the high. Here come the phone calls, making everybody wondering if everything's okay. It's going to be okay. What we're really
Oh, sorry. Go ahead.
Well, what we're really trying to avoid is that 30% drawdown, because that's when losses become much harder to replace unless you have new contributions that you're able to put into your portfolio. To emphasize this further, I'm actually going to use a BlackRock slide. Sorry, Megan, I kind of borrowed a bunch of your stuff, not from your deck, from other decks. We borrowed a BlackRock slide where it's really excellent job of displaying where losses really stack up. If we see a 30% decline, we have to make a 43% gain to get back to break even. And the bigger that loss, the more exponentially difficult recovery actually is. Prior to that 30% level, to a 20% level, that really is what I would call a zone of tolerance. You have to be tolerant of this. While 14% is the average, you have a range around those outcomes that you really need to be able to hold through if you're going to be an investor. So keep that in mind. If you're going to invest, you need to be able to tolerate some downside volatility. And my table here in the top right really features that. About once in every 4 years, you're going to have a 20% sell-off. Once every 10 years, you're probably going to see a 30% sell-off. That's going to be part of your experience if you're going to be an investor in markets. Now, of course, we try to handle that with some of our models that are more actively focused that manage risk. What we know about that is if we get a standard decent return for a long time frame, we end up with the same result than if a portfolio that kills it, that you're bragging about, and then end up divorced in year 5. Your outcome is no different. I submit one of these portfolios raises your risk of having a heart attack. You probably want something more like this in your older age. On top of that, we know that withdrawals are the opposite of dollar cost averaging, what we call dollar cost ravaging. If you're taking money out of your portfolio, that means after a decline, you have less money to recover from, making it harder to recover from. In this instance, if you have a 10% sell-off over a 5-year period, taking out 4% a year, you need a 43% gain to get back to break even. That's equivalent. This decline here is equivalent to taking a 30% loss. This is why if you're in that distribution phase of life, you need to be more risk adverse, in our opinion. Now, how you do that, how you are more risk on or more risk averse, really comes to asset selection. Higher risk assets, well, they have higher return potential. Everybody loves that. Everybody wants to hit the long bomb in a single stock, not recognizing that you have the other side of that coin, which is a strong negative potential. More conservative assets like treasuries outside of 2022 usually have a much narrower range of outcome, meaning you have more dependability about where your results are going to be in the future. If you need to have a more certain outcome, you're retired, we need to shrink this window of opportunity. If you're younger, you can shoot for the moon a little bit. We can take more risk. That means you're going to go for a bigger ride. That's easier to do when you're younger and have the ability to make new contributions. Adding on to this, what assets we use have that as well. If we use stocks are typically, stocks and equities are interchangeable, the same thing. Equities, stocks typically have a wider range of outcomes, a wider range for things like emerging markets, buying places like Indonesia and China versus buying into the US. Similarly, in fixed income, in the bond space, where we're buying assets that pay us every single month, junk bonds or high yield bonds, companies that have a higher rate of default, you have a wider range of outcomes, but that's also where you can get a higher rate of payout versus treasuries, which usually are safer. Blending those two together, we can give you a better, or a mix that might be more appealing to you depending on where you are in your life and your own innate risk tolerance. If you want to have the best return possibility, you need to be 100% stock, because it also comes with the worst return possibility in a single year with the highest average return. If that doesn't seem appealing, we can give you a lot more bonds, in this case, a 40-60 portfolio where your upside is not as great, but neither is your downside. and your average return is not as great as well. These are the kinds of discussions we have with you guys when you come in and decide what blend of assets do I want based on my needs, risks, and desires. Maybe pop forward a slide in the sake of time. How we manage the active models is different than how we manage the index models. Index models are all about, let's buy a group of assets and weight them accordingly based on what would have performed well over long time frames and multiple cycles. Active models are saying, what is the current data environment and what has typically happened in the past when data environments are the most similar to how they are today. We break these into 5 main categories. What's the economy look like? How's price momentum? Are prices going up and down? Interest rate policy, what's the Federal Reserve doing? How tight or loose is it? Valuation, how much am I paying for what I'm getting? And human behavior, which is a big one. One of my favorite quotes about the market is, in short time frames, the markets are a voting machine and are about rich people's feelings. I'm not saying as eloquently as I want to, but I think I get the point across. In our case, where we are today, we would say the economy is relatively mixed. And again, this is our opinion, and Meghan might have a very different one. I know some on the street really have a much more optimistic view than I do about the economy. What I'm looking at is a real mixed economy where you're seeing some bright spots, but in a relatively few number of names and in a pretty widely spread weakness overall in manufacturing economy, especially. Valuations are sky high. I would worry less about this if valuations were cheap. We are paying the most for stocks in the history of the stock market right now. And on a positive note, prices being up is a good thing because people believe in what's called recency bias. If something has been going up for a while, it probably is going to keep going. So that feeds into behavior. If prices are going up, I'm going to keep buying stocks because my greed becomes a factor. Now, we have seen more volatility creep into the market lately, so I wouldn't say that I believe that greed is necessarily present, but I do believe that is still a driving factor. This is more of a neutral category. Interest rates, we did see a sharp climb up in the last 5 years, call it 4 years, but we are seeing loosening Federal Reserve policy. They just cut rates last month, and we are seeing resolution of the inverted yield curve, which is something that people who've been clients for a long time know is something that we pay attention to as a warning sign of coming recession. To keep this short, I'm only going to give an example of the valuation spectrum because I believe valuation is the biggest concern right now. Looking at our favorite measure of valuation, market capitalization to gross domestic product, think of that as the combined value of everything divided, or combined value of every stock divided by the economic output of our country. On average, typically this ratio is less than 1 over the long run. Right now, as of 2 days ago, it was over 2 times that level. This is over 3 standard deviations above the mean, meaning something statistically you should never see. Just to get back to mean reversion, or get back to full mean reversion to average, would be a 58% decline in market valuation right here. To get back to 1, which is where I would say normal valuations begin the upper level of normal, that would be a 39% decline from where we are today. Valuations aren't useful in the short term, but they suggest long-term market pricing weakness. In fact, Goldman Sachs 2 days ago came out with a report suggesting that we should only see 3% average annualized rate of return in the stock market, at least the domestic stock market. So that should really be an environment, and that's over the next 10 years, that should really be a good environment for active management, in our opinion, rather than passive. So something to think about when you're deciding which one of those models you want to participate in. To kind of illustrate what 3 standard deviation means, here's the average. Your normal range is between the 1s. Out here at 3 standard deviations, statistically, you have a 0.15% chance of going higher. So not that you can't go higher, it's just really, really unlikely. And it's not just our favorite measure of valuations, it's essentially all of them. This is a big concern for me. It's not just, one of these things is expensive. It's saying markets are expensive historically by every measure that Wall Street basically looks at. On top of that, it's being driven by fewer and fewer companies. The top 10 companies are now 36% of the S&P 500. If you buy an S&P 500 index fund, you're buying 36% into 10 companies, which most of them are being driven by the AI boom. You have global stock markets being driven by NVIDIA, which is being by a little tiny bit of AI demand, which, by the way, at this point, is not making any money. So valuation remains our primary concern for markets, which is why our risk adjusting models, the areas highlighted in orange here, are at least at some level more risk off. Normally our aggressive risk adjusting model would be more in the 0.9 range on beta, and to explain beta, that's a measure of correlation with the S&P 500. If the S&P 500 goes up 1%, our model should go up 0.36%. If it goes down 1%, I would expect it drops 0.36%. That's kind of the simplistic explanation of that. And we have a really nice yield. This will actually be over 5% by the end of the week based on some trades that we're doing over the next couple of days. But what we're looking at here is for our clients who are the most risk averse, who need to make sure they preserve assets rather than grow assets, we're really prioritizing income over principal appreciation, over value appreciation. On the other side of that, we have our indexing product or index product, which does have a very high beta, because this is for our people who just say, I want to have market exposure. I want more value appreciation than income generation. And then we have models in between with global allocation and tactical allocation. Again, I can't get into all those things. I don't have time to do it. But if you want to hear more about how these things are run differently, and they are very different strategies, please make an appointment. We can go through that. I want to finish up with, of course, some comments on the election. You can't get away from this. This is coming up. What I want to point out here is what I always point out to you guys. Markets don't care about your political opinions or the political parties. There is zero explanatory power, whether you have a Democratic Congress, a divided Congress, a Republican Congress, one president or the other White House. There is no explanatory power for party and outcome in the stock market. What I do care about as a person is that we're likely to end up with a split Congress where you have one party controlling, either the House or one controlling the Senate. Regardless of who ends up in the White House, there's unlikely to be party control of all of government. I personally like it this way because it makes it really hard to get things done, and I like a government that can't get things done, as an equal opportunity hater of all parties. One concern about this is we do have the upcoming expiration of the 2017 Tax Cuts and Jobs Act, which would, if it fully expires next year, which is scheduled to expire, which means if they do nothing, you see a $3 trillion tax hike in 2026, beginning of 2026. That could be a big deal for the overall economy. I'll leave this here for a moment. So when you guys watch the replay later, you can pause it here if you want to read through these. We're not going to spend a lot of time on this because we don't know who's going to win the White House at this point or Congress at this point. And so we'll deal more with this when we see what they start passing next year.
Well, can I chime in there, Morgan?
Go ahead, Brian.
So let's just put that in perspective. A $3 trillion hit to GDP, and Megan, feel free to chime in here too as well. GDP is estimated to be about 28 trillion by year end for the United States. So tax cuts expire. That's $3 trillion that was being saved by U.S. consumers and businesses in taxes that was now going to future goods and services. That's now going to go to the government. So that means GDP is going to drop by 3 trillion. That's not going to help corporate earnings because that's money not going to their bottom line by consumers or businesses. And so if we had to pick anything that maybe is meaningful, the known versus the unknown, this is one of those that we could say is a concern because, correct me if I'm wrong, Morgan, but this market isn't priced for perfection. It's priced for a miracle. This is insane right now. I can see Megan nodding along. Feel free to chime in, Megan. I mean, it's something else.
Brian borrowed that from a JP Morgan strategist that we spoke to recently, and that was his phrasing. It's priced for a miracle. It's you need everything to go right. And you may see, and don't be surprised that we get through this earnings season where you see a great report come out of companies like NVIDIA or any other big tech companies where it's just not as good as expected. And so you see markets sell off hard. We saw that last quarter too. And that's the problem with high volatility guys or high values guys. It creates a fragile market environment where you have some kind of catalyst that can create a sharp sell-off. And that's why for clients who can't afford to have that volatility tolerance, I would encourage you not to. But
well, and the economy's not terrible. It's just we've gotten a little ahead of our skis. And I heard someone else say the other day that we've become comfortably numb. That all of these bad things that usually would create some hiccups in the market, they've been happening so frequently, and the market has just kind of charged through all of those that they've become less and less significant until one day they are, right? Like we have the Ukraine situation going on. We have what's happening in Israel. We have, well, now the Fed's finally cutting interest rates, but we had the inflation, we had unemployment rising, all the things that historically had a little bit more impact, but they just seem to be becoming less and less significant in terms of the way the market's responding. So we're interested to see what the future holds.
Absolutely. So try the buzzers last a little bit so we can get Meghan in here, our keynote. What also matters for our budget. I highlighted a piece here from JP Morgan where they show that spending in 2015 was $3.8 trillion and our borrowing was just only $469 billion. Currently, current spending has jumped over $3 trillion and that borrowing is more than quadrupled or almost quadrupled to $1.9 trillion. That's a lot of borrowing. That's a lot of deficit spending. You want to know how the economy survived a lot of the things we went through the last few years? Is because they're spending money like drunken sailors, and that's making drunken sailors look bad, in my opinion. It could be that you need higher taxes to help kind of bridge this gap. So don't be surprised if they let a lot of these things expire, even if you have party control of Congress.
Mm-hmm.
Our friends at Vanguard highlighted this in our spring event where, where does high debt become an issue? Well, they estimate if you add 5% interest rates, it becomes a real problem in about 2053, which puts a lot of you off the hook. Aren't you lucky? I'm still here. So are my kids. So are a lot of your grandkids. This is a real concern. And what happens if inflation ends up being higher and rates stay higher longer, or borrowing or deficit spending increases? There's a lot of things that can change this outlook. The point is, the trajectory we are on is not a good one for the history of or for the future of the country. This also represents an area where you're probably going to see what's called fiscal dominance, where fiscal spending was happening at the Fed. Or Brian, what was you saying for this? F is for, or fiscal.
F is for federal.
F is for federal. So if you think fiscal spending, guys, that's a federal government spending. What they're doing, the high rate of deficit spending, is going to start impacting what the Federal Reserve or the monetary decision is for the future. Are they going to have to keep rates lower than they would like to because they don't want to bankrupt the country based on that scenario I just showed you a moment ago, where too higher rates move us to unsustainable GDP or debt to GDP levels? So what we're looking at in our future probably is higher inflation. Don't be surprised if they come out and say, well, that 2% inflation rate we said we're going to make that 3%. We're going to tolerate that instead. That probably means that interest rates are going to have a higher low level. Don't think we're going back to 2020, even if we get another recession. The dollar is probably going to continue selling off. I'll touch on that more here in a moment. And you're going to have more conflicts in budgeting. Right now, interest on the debt is actually a bigger line item than military spending. Think about that for a moment. The interest on our debt is more expensive than all of our aircraft carriers, airplanes, soldiers, bombs, et cetera, and so forth. I know that currency comment, probably set a couple of people off. I know this is a big worry. I'm going to point out the dollar has been losing share of world currency or reserve currency value for a long time. We are still 60% of global reserves, and we're still 75% of global transactions. The dollar isn't going anywhere anytime soon. It's going to continue to be our currency and their problem for quite a while. Last piece on politics, on geopolitics. That typically when you have crises like Ukraine, or you have the situation in Israel where they could attack Iran any day now, and God knows what happens when that occurs, markets don't typically care about this outside of recessions. These gray highlighted areas, these are the recessionary environments. And so far, we can't say that we are, in fact, in a recession, though I continue to worry about it more than some people do. If you have a big geopolitical shock, that does tend to make those situations worse. But really, whether the economy is negative or not, that's a bigger issue than whether you have some geopolitical shock on the other side of the world. That said, we're probably heading into what's going to be a volatile election experience here in a couple of weeks. We've already had multiple assassination attempts on one presidential candidate. We had a presidential candidate drop out. It's been amazing how resilient the market's been already. Don't be too concerned about this, but kind of brace yourself for more volatility going forward. And finally, I'm gonna cruise through this part because we're already over time. Sorry, Megan, we'll get to you, I promise. Monetary policy, what's the Federal Reserve doing? It really bothers me as a free market capitalist that we are so attuned to what are a bunch of unelected bureaucrats doing as far as decision making. But that is where we are today. We are paying attention to where is Federal Reserve policy. What we know in 2022 it skyrocketed, and now they just started cutting, and we'll see where it goes from here. They cut about 50 basis points. The interesting thing about this cut is you've actually seen yields on bonds go higher afterwards. With Megan, I'm going to ask you that question. Like, I'm asking everybody that. Like, what does this mean? It's highly unusual to see yields on bonds go higher after you see Federal Reserve cuts. And that suggests to me that this forward outlook for future rate cuts, which is currently about 1.5% more lower rates, may not happen. Could that happen because we end up in another inflationary environment? That's really my favorite catalyst for that. But what we do know is rates have been cut right now. And if we don't get a recession, typically that's a really good environment for US stocks. There's a reason that everybody has seen a little bit more aggression in their portfolios over the last few months, even our most conservative clients, because we've seen improving economics, even though valuations are still high and we haven't seen a recession. That suggests we could still see market valuations go higher. And if they're going to go higher, we want to participate in that. But we're going to participate in the environment more in the income side of the spectrum for those active models, because we can be highly certain of a positive outcome regardless of whether we get a recession or not, where if we do have a recession show up, typically that's not a great environment for stocks. Finally, on inflation, we've had one of the best outcomes for inflation fighting in history. Typically, when you see inflation rise above 8%, you see it continue to stay high for many, many months. These are months here on the x-axis. What we've seen is inflation has come skyrocketing down for a variety of reasons, much faster than expected. Really, this is one of the best outcomes in history. So we should all be glad that happened. Is it sustainable, or are we going to see something like we saw in the 70s, where you see deficit spending, like I mentioned earlier, cause inflation to skyrocket back up again and cause higher interest rates in the future? That's an unknown at this point, but something we need to manage. As you guys have heard me say time and again, we're always going to focus on managing risk for you based on your needs and tolerances, and based on the model that you select. We're going to control the cost of the assets that we use, time and behavior. This is really what you work on with your financial advisor relationship. What are your goals? What's your timeline? What kind of variance can you handle? Markets are going to do what markets are going to do, and we're going to do it the best we can to get you the best outcome in those environments.
All we can do is set the sail.
That's right.
So, Morgan, before you stop sharing, there's a number of questions that I think you might want your slide deck up for. And before we move on to Meghan, because otherwise we're going way back in history here. So how does the S&P 493 look? In other words, if you remove the Mag 7 from it, what does it look valuation wise? Sure. Do we have that? Do you have that on the deck, on the bench?
I don't have that chart in this. So I had to have a limited deck today. They're limiting me. My big deck has 221 slides in it. This deck has 40.
Okay. So we don't know the answer to that. Okay.
I do know the answer. I just don't have an illustration for it. So the answer to that question is it's cheaper than what you see, versus the entire stock market. It's still expensive based on its own history. So if you had
to guess, just marking it on that chart, with the standard deviation lines, where would it put it, do you think?
So if you look at price to earnings ratios, let me get into this. You look at price to earnings ratios of the 493. You're going to be at level similar to what you saw in 2000. So the question is absolutely valid. It does matter. Those top 10 or 7 companies are greatly inflating valuations. Valuations aren't cheap if you remove them. They're just cheaper.
Yeah. Great. Thank you. And then running with the same person, not loving the 2017 tax cuts, to full disclosure here. He was thinking that, once the tax cuts expire, that really what happens is it will remove a lot of the largesse, the excesses that came from those tax cuts, and that will return to more of a normal valuation. I hope I'm saying that right, type of marketplace.
Is there a question there?
Well, I just wondered what your opinion was on that.
It's some trade-off. The thing I would point to primarily, the kind of counterpoint to that, is the SALT deduction. What the 2017 law took away a cap on that. So wealthier people in high tax states actually ended up paying a lot more in taxes, and those same wealthy people are going to get those deductions back if they do nothing. So it actually will, in certain places, it'll be a boon to the wealthiest people out there.
Yeah. Well, I mean, around here we've got high property taxes. I would definitely benefit from it.
So I would say it's not as easy to say, okay, that the 2017 benefit rich people exclusively, and the expiration won't. It's really going to be give and take depending on your location.
Yeah. So, and what I would say is that I think more of the excesses that we're dealing with today actually has to do more with Federal Reserve policy in response to COVID. I mean, essentially, they pumped $5.4 trillion into circulation from the magic money tree, and we're now experiencing the inflation as a result. And unlike what we did with QE1, 2, and 3 post the housing crash in 2008, where we printed money but we sent it to the banks to shore them up, we sent it to people's bank accounts. And so that immediately had a dilutive effect and went into circulation immediately. And so I think personally, and Meghan, you're welcome to chime in here, I think personally that's probably the largesse that we're dealing with here, is that money went places, including the stock market, and it is pushed it's kind of made the stock market a bit more like a casino right now. And I do hope that those excesses do work themselves out.
We will take all of Megan's time. We discuss that here right now.
Yeah.
Any other Q&A questions that can't wait till after Megan?
Yeah. So one question came up is, do we know how probable it is that a recession may happen?
Well, it depends on who you ask. So if you look at Goldman Sachs, they have, I think, less than a 30% chance now. So, and it's been dropping. The Federal Reserve of New York has a 56% chance of recession based on what they look at. Yeah, and we aren't really assessing recession probabilities as we are looking at market fragility with our data models. What we were saying is in the current setup, you have a fragile situation where you get a catalyst like a COVID, or you get some kind of geopolitical event where, say that Israel went and did decide to take out a good chunk of Iran's energy infrastructure, causing oil prices to spike. That could be a big problem with valuations where they are today, because we're not pricing in that risk. That's what we're looking at with our data models. Yeah,
it sounds to me like it's more like a 50-50. And, there's the chance of a soft landing, but that's so rare, but it does look like it's more possible than it has been in the past. Yeah. So Megan, it looks like you have a comment here.
Yeah, we have a couple of things that we can get into on that, but I think, Morgan, it's going to be fairly aligned, which is we're quite constructive on the economy. And I have a chart that I'll share when we get into it that shows our recession probability forecast and what consensus looks like. But I think really importantly, that pricing element, even if you think the economy will keep doing well, even if you think we avoid recession, it's that what's priced in markets that still does give us a bit of pause. And so it's separating, what do we think about the economy? What do we think about the markets? And right now it can look a little different.
Yeah, I don't want to put Megan off anymore on that, Brian. So let's get her involved here.
Okay. Well, there's a lot of questions. This all spurred a lot more questions, but we'll go ahead and put those for later. So while we switch over presentations, let me introduce Megan real quickly. So now I'm going to give the abbreviated introduction. I don't want to, so feel free, Megan, to chime in if there's anything that you feel like is, hey, don't skip over that. But Megan's been with BlackRock now since 2009, correct?
Right.
And she started out actually on the BlackRock Global Allocation Fund, which I'm guessing most of you have probably seen available in your 401k or something. It's one of the largest asset allocation funds in the world, if not the largest. But today she's actually a director, and she's the deputy head of product strategy for the BlackRock Multi-Asset Strategies and Solutions team, which is one of the reasons she's here, because you have the BlackRock, it's the multi-asset strategy or multi-strategies. Correct me if I'm wrong, Morgan. You might have to help me on the name here.
Sorry, I was answering questions in the chat. Yeah, so Megan, of course, it's a big strategy. Maybe we should let you introduce yourself.
Well, no, but Morgan, what's the name of the BlackRock fund?
Oh, it's the Tactical Opportunities Fund.
Tactical Opportunities Fund. Thank you.
Sorry, I was in a whole different world.
Yeah, and she's also in the multi-asset strategies and solutions team as well. So with that, I want to kick it over to Megan. And Megan, take us away with what BlackRock's perspective is on markets.
Great. Thank you so much for having me and for the introduction. I think you got all the highlights, so we'll leave it there. I'm really glad to be able to join you today and share some of the way that we're thinking about markets. We did not talk in advance and kind of compare notes. And I think Brian and Morgan, I appreciate you kind of allowing us to come in independently. I think you'll hear a lot of things that kind of are rhyming. So hopefully that's helpful, but want to just be able to share the way that we're looking at the world. I think just to introduce that first and put in context what we're going to talk about here, to briefly talk about the team and kind of the lens through which the team is forming these insights that I'll share is hopefully helpful. So the Global Tactical Asset Allocation team that Brian referenced in the introduction has for 15 years been delivering outcomes for clients. That's through the Tactical Opportunities Fund. That's more broadly. And the way that the team really does that is by looking at macro data. And so we're very focused on things like growth and policy and inflation. We think a lot about what's priced in markets, as Morgan and Brian, you do as well. And then the investment universe that we're looking across when we're building portfolios, and where are we thinking about this sort of data, and what are some of the insights that I'll try to bring out here in the next little bit. We're looking across countries, so it's global in nature, 25 plus countries. Think about like all of the developed markets, some of the most liquid and tradable emerging markets, and it's multi-asset in nature as well. So we're thinking about stocks, we're thinking about bonds, we're thinking about currencies. The way that I'm going to try to frame this up, the universe is really big. There's a lot of different things that we look at and talk about. But the way that I'm going to try to frame this up is going through some of those different fundamentals that we're focused on. So what do we see today in growth? What are our expectations for inflation? How are we thinking about policy, both monetary and fiscal? And then I'll try to bring that together in terms of what are we doing in portfolios as a result of that? What are some of the things that we're really talking about and doing for our clients? So digging in, starting with growth, and I think this is a good spot to start just because it picks right up on that last question that was asked. U.S. GDP growth, gross domestic product, a measure of growth in the U.S. has come down over the last year. And I think there's been a lot of headlines about that. And we talk a lot about growth slowing, just like we do with inflation, just like we're talking about a lot of these different moves. I think the other thing that's really important, and Morgan, I like some of the charts that you shared that put things in a little bit of a longer history as well. We can get stuck in recency bias. We can think a lot about kind of what was the direction of the last tick in data or in markets. But putting things in more historical context, I think is really helpful. And what you see here, when we look at growth data out of the US, while it has come down, we think that it remains quite resilient. And two different ways that we look at that. On the left here on this page that we just brought up, we see a relatively low likelihood of recession. Consensus odds have come down as well. So if you look at consensus and you look across Bloomberg does this, they collect a bunch of different data. If you think back to where we were at the beginning of 2023, there was this phrase that we heard a lot. It was recession foretold. And I think there was almost 100% chance that some people were putting on recession. I think putting 100% chance of anything is really tricky. There are a lot of unknowns in this market, and there are a lot of different things that can happen. But, safe to say that the consensus was really high that we would have a recession. And the idea was that interest rates being at a higher level, inflation where it was going to put a lot of pressure on U.S. consumers and make it really hard for the U.S. to continue to grow. Of course, now, almost 2 years later, we know that things have gone okay, at least so far. And what you've seen is that consensus expectations for recession ahead have come down quite a bit. We kind of have our own model that we look at BlackRock, where we think about things like unemployment rate. We think about things like corporate taxes and spending. We think about things like small business optimism and that survey data that exists where you go out and ask lots of different small business owners, what are they thinking about the economy? So all of those things together, we kind of combine that to get our own measure on the likelihood of recession. And again, both of these things have come down quite considerably over the last year. We think that's right. We think the U.S. consumer is set up quite well here. We think there's a lot of opportunity for the U.S. to continue to grow. I'll remind you that doesn't mean that the stock market continue to grow. These things are a little bit distinct, but that's sort of our base case for where we think growth is. Now we look at all this sort of data, we look at where US GDP is, but the other thing that we do a lot is we look for other ways to measure. There's a lot of information out there, things that you can read in the newspaper, things that we can find on Bloomberg, things that we can sort of calculate ourselves. But one of the things we like to do to check some of our thesis is look at other ways and what we call alternative data to kind of see, is this really playing out, right? We can see what the forecast is from Goldman Sachs or from whoever it is. And so one of the things that we do there is we look at what is U.S. materials production. And I think one of the really cool things is freight activity. So one of the first things that you need to do when you are going to produce goods and ship goods and think about or on the other side of the supply chain to buy something is you need to reserve a spot on the ship, and you need to kind of have like that spot for your cargo. And so you can get a little bit of a leading indication, a little bit of a more forward-looking view if you look at things like rail traffic or truck demand. So these are things that you can go out and you can ask the small business owners, how do you feel about growth in the next couple of years? And that can be really important, and that can be a good input. But we can also see, okay, who's actually shipping something, whether it's by rail or by sea. And again, these further support the idea that growth is pretty steady and even improving in some areas.
So if you're okay with me asking a question right now. We've been hearing about this, but then we're continuing to see consumer debt in particular skyrocketing. And with the U.S. consumer now representing almost, well, really basically 2/3 of GDP, and all the credit card defaults and record credit card levels and record credit card rates, and now student loan payments resuming with an average of $450 a month. We're seeing auto loans defaulting and worse since now '09, I think it is. How is this not mattering? How are we not seeing this reflected in the economy yet? It's amazing to me.
I think that's all right. I think there's a couple things that we're pretty focused on that are helping with that. Number one is wage growth. So we think about some of these challenges. There's a higher cost of debt, right? Interest rates are higher, and that's impacting your auto loans, your credit card loans, your mortgage. But because wages have also grown with that, the affordability is not as concerning. We also see folks still have a lot of money from COVID. You talked before, Morgan talked before about some of the stimulus that occurred that went directly to consumers. Now, a lot of that savings and that kind of balance has been drawn down. But if you are still growing your wages, you're feeling the impact less. And then the last thing is that a lot of people did what we call, and this is both true for both individuals and consumers as well as companies, did what we call termed out their debt. And so you bought a house in 2021. You locked in a mortgage. In the US, we mostly have fixed rate mortgages. You are not feeling directly the impact of higher interest rates. And so that will come, but it comes more slowly than what we maybe see or what we see in a place like Europe, where you have a lot more variable rate mortgages.
Yeah. And that's for our perspective as well, is that, the saying is you go bankrupt slowly, then all at once. That consumers, because of the wage increases, they've been able to make the payment. They will make the payment, but the labor market, employers had to pay up to keep the employees. But now that labor market is getting tight. And so I'm curious if they're not going to see the wage increases like they saw before. Anyway, I don't want to spend too much time on this, but that's the burning question, at least for me. How is this not manifesting?
Right. If I might chime in here, we got a question on the charts, which is, what is the Z-score? To answer that, it is a measure of standard deviation. So I called it standard deviations earlier. Z-score is synonymous with that. So you're looking at -1, -2, -3, or positive standard deviations from the average. So it's beyond one on either direction. That's where you're starting to see outliers.
Thank you, Morgan.
Look, for compliance reasons, we have to put the label on there. I think it is helpful to have the label. I think when you look at a chart like this, Morgan, what you just shared is accurate. I think the other thing you can do is kind of ignore what that label is and really focus on the direction. Right?
Yeah, right. Direction is more important.
For a lot of the scores that we have in here, we use scores as a way to just kind of normalize something. Rail traffic is measured in different units and kind of look very different if you put it on the same chart as truck demand. Turning those levels into scores helps us to put it on the same chart and think about how it has looked over time.
Yeah. Sorry to hog this slide. Go ahead.
That's okay. So maybe moving a little bit from growth, which is sort of the first category that we think about in terms of things that impact the economy from a macro perspective, into inflation. I think our view here, Morgan, is really similar to yours, and it's rhymes with what I just said about growth. Levels have come down from the highs that we've seen, but in our view, it's likely that the next turn for inflation is up. And a big thing that's influencing that and driving our thinking around that is what we call core services. And so what you're looking at here on this slide is the white line is just showing you where inflation has been over time. But then the colorful bars are showing what is driving that inflation. And so what you can see in a year like 2021 or 2022, you had services prices, you had goods prices, you had food prices and energy prices, all driving inflation higher. All of those prices were moving higher. Now, as we've gone through last year, you can see energy prices actually came down, right? That might be something that we kind of all experienced in our daily life. Food prices have kind of flattened out, so they haven't come down, but that pink bar is disappearing, which means that food prices are kind of leveling out. Same with goods prices, and even in some cases, we've seen goods prices come down. A lot of that, in our view, is sort of working through some of the supply chain issues that came on the back of COVID. As those things have been worked out, some of the price inflation that we've seen has abated. What hasn't really given up as much is core services. And that's things like going to get your hair cut, or rent falls in there. All things that really, in our view, have much stickier prices. One other thing that is not specifically called out here, but is driving a lot of our thinking about core services and that we're very focused on when we think about inflation, is insurance prices. Insurance is in this category of things, and there's other ones there too, education prices, some medical prices, where prices don't reset as often. The gas price, and you go to fill up your car, you go to fill up your tank, that price is fluctuating all the time, right? They're changing the price on that sign daily. When you're buying insurance, you're doing that maybe every year, and so the price can't reset as often. When you're paying tuition, whether for college or daycare or any kind of school, you're typically resetting your price annually. That means that those things flow through more slowly. And then specific to insurance, there's often limits on how much, government set, regulatory set limits on how much insurers can raise prices. But insurers are facing huge costs, huge rises in their costs as a result of more frequent climate incidents. So you see, we've had hurricanes in Florida, we've had fires in California. That is driving costs higher for a lot of insurance companies. And then just inflation is creating higher costs for insurance. Your house last year was worth a little bit less than it is this year, replacing something on your car, all of those things. And that flows through slowly in insurance prices, but has a huge impact on the economy because insurance is sort of an input cost to so many different things. Electricity is in that same category. If the cost of electricity goes up, the place where you get your coffee in the morning now has a higher cost and is going to pass that through in your cup of coffee. Insurance is just like that. It impacts just about everyone out there.
This might be a great spot for the question that someone asked a little bit earlier, which is, if inflation's lower, why is it not reflected at cash registers, and will it ever be?
I think that's a great question, Morgan. And we talk a lot about this on the team of, the lived experience with inflation doesn't really feel like inflation is as lower. Being told inflation is lower. I think one of the things there is, inflation at 2 or 3% means prices still are going up. So on a relative basis, it's going up less. But I think to some extent, there's this sense in some of the rhetoric around inflation is as if 2% means that inflation is gone. And by the way, we aren't even at 2%. But I think that's a good call out that inflation is a little uneven, and the experience that a lot of people are having and the way you're feeling inflation doesn't feel like it's not a problem.
Yeah. Well, and I think you would actually have to see commodity prices, the price of the goods that they're either selling or the raw goods they're buying and then making whatever widget from has to come down dramatically, because labor costs aren't coming down.
Correct.
Unless we have a big recession and there's a bunch of layoffs, and that lowers that overhead, because it's not like you can cut the price of widgets if your input costs go down, right? The commodity price comes down, but you're not going to get everybody to voluntarily take a pay cut. So once the inflation made it into the labor market, which we're seeing in the core services, for example, it's sticky because people aren't willing to take those price cuts, whereas the price of gasoline, gas doesn't care, right? It doesn't.
That's a great point. Yep. The nature of the price increases in core services, just by definition, is stickier.
It's going to be heavier on labor versus core goods. So.
And then look, this is not just happening in the US. Like I said before, we invest globally. We think about lots of different countries and regions. This is a problem in a lot of different places. Here, just calling out the US, the UK, and the Eurozone. What was inflation at the beginning of the year? What was it sort of mid-year? Again, I think some of these can trend up. We've seen inflation come down a little bit in the UK more recently, but these are all above. This is not just a US problem. This is really more of a global phenomenon. And something that we're keeping a close eye on, to the extent that inflation impacts stock prices and bond prices. It can have an impact on currency markets. So really, really core to the thinking.
Well, and every country you just mentioned there has run high deficits and high debt to GDP. So interest rates matter.
That is right. I'm going to get to that in a second. And actually, the UK is a little bit of a standout case, but that's exactly right. Maybe before we turn to fiscal policy and deficits, which I think is of high interest for our team, as well as you, Brian, and Morgan. One of the things that's really important for inflation, and one of the reasons that we're so focused on inflation and the way that it plays out in the bond market, is through the Federal Reserve's policy rates. This rhymes really closely with one of the charts that Morgan shared. And what you're looking at on the left is, I forget what the title of the chart was, but I think it was something along the lines, Morgan, of markets have been consistently wrong about pricing.
Correct.
That's exactly the point that I'm making here. The kind of the darker line that kind of staggers up and is solid on here is showing you where rates have been, where the Federal Reserve has been over the last, starting from November 2022 to now. And then the dotted lines are showing you where the market at any given time, so in January and June, in September and currently, thinks that it will be going forward. And there's two things that I would take away from this. Number one is the market has pretty consistently been wrong to the downside. So the market, and this has been true for a couple of years now, the market has been wrong, and usually on the side where the market is expecting rates to come down more quickly than they actually have. And then the other thing you can see is that the market has been kind of all over the place with these expectations, right? These lines are moving quite a bit. This is just over the course of this year. These are pretty big swings in what people are expecting. And what that has meant is what you're seeing on the right, is that we've seen more volatility, more risk, more movement in the bond market than we have maybe in a period in the decade prior to 2020, for example. And you see that in the yellow line, where we're just measuring the sensitivity of bond yields to economic surprises. It's pretty high right now, and that's directly related to the uncertainty that exists around what will interest rates look like going forward.
Megan, maybe this is a good spot to ask you, what do you make of the fact that yields on bonds have risen since the Fed cut rates in September?
That's a good question. It was a little bit of our base case even throughout last year, that it was likely that the Fed would cut and that you would see the longer end of the yield curve move higher. And so when you think about bond yields, the Fed is kind of directly controlling what the cash rate is, and there's lots of things that feed into what the other interest rates are if you're buying 5-year bonds or 10-year bonds or 20-year bonds. And then of course, if you get into to high yield or credit, you have even more factors. But just even focus on treasuries, there's a lot of things that drive the longer end. One of the things, Morgan, that we're pretty focused on there and why we think it played out the way it did is markets had suddenly and this is the pricing that you see on the left. When the Fed cut rates in September, they cut by 50 basis points. And on that day, before Jay Powell said anything, the market was expecting 150 basis points of cuts this year. So they were expecting, Jay, for the 3 meetings that existed, that were kind of still to come in 2024, that there would be a 50 basis point cut at each of them. And actually, at some points, the pricing was even beyond that, which suggests that the market was expecting maybe there would be some sort of emergency meeting or an even bigger cut at one of those meetings. And so you have, and this is a little bit what we talked about with growth and stock market pricing, you just had a little bit of a disconnect between what is the reality and how excited markets were about what might come. And then I think hearing Jay Powell kind of make the cut, but then talk through how he was thinking about the rest of the year and how the Fed was thinking about the rest of the year brought a little bit of reality back to that. The other thing that we're thinking a lot about is at that longer end of the curve is there are these other things that drive it. And maybe I'll move to the next 2 slides to talk more about what those are. One of the things, and Morgan, you touched on this, that's kind of unique right now is the yield curve is what we call inverted. And so typically when you think about the yield curve, you're getting paid a little bit more if you loan your money for longer. If I've loaned Brian money and he's going to give it back to me tomorrow, I might not demand any interest, but if I'm going to loan him that money for a year, there's a higher cost of me loaning that money and I want a little bit more back. Right now, we have lower rates as you go further out the curve. And that means that actually, the longer you're lending the US government your money, you are accepting less and less back from them. That typically means that you think that rates are going to be lower in the future. And so you want to you say, oh, listen, I know I could get more today, but I'd rather just give it to you and guarantee, or as much as there are guarantees, I'd rather kind of lock in that rate going forward. But I think if you have a more positive outlook on growth, and if you think that actually the economy is okay here, you're less willing to do that. And so part of it is there's just those different factors that are driving the long end. We talk about something called quantitative tightening. Quantitative tightening is the way that the Federal Reserve, in addition to thinking about interest rates, can influence the bond market and influence the yield curve by buying bonds. And so they did a lot of this over the course, they did a lot of quantitative easing, buying bonds over the course of kind of the post-global financial crisis and COVID period, where they were buying bonds in order to help to stimulate the market. And now they're doing the opposite of that, which we call quantitative tightening. And they're starting to unwind that balance sheet. So basically the Federal Reserve has bought a lot of its own bonds, taken them out of the market. Supply and demand suggest that makes bonds that has an impact on yields. Now, as they've taken it out, and what we're looking at here, I put this cartoon on here because I think we're in good shape. Nobody understands our financial statement. Once we start to get into accounting, and I'm not going to go too deep on this, but we think this is underappreciated by the market because it's a little wonky. You have to kind of really dig into the accounting. It's not a really kind of fun and sexy story to be thinking about. But what we're showing here is the Federal Reserve has come out and said, nope, we're doing quantitative tightening, and we are going to reduce the balance sheet that we have. They've reduced it by $1.5 trillion over the last couple of years. But because they're doing that more at the shorter end of the yield curve, the impact on the bond market hasn't been as great. And so you think about duration as a measure of the impact. And so kind of to put it in more basic terms, they're playing a little bit of an accounting trick that the market isn't really kind of keeping up with, in our view. And they're saying they're doing something, and they are doing it, but they're overstating a little bit what the impact is there.
Mm-hmm.
The other thing, sorry, go ahead.
There's a great question here. So this client, I believe, he worked at the bond desk for MetLife at one time. What is the impact of the Treasury trying to force long-term rates lower by issuing less long-term debt and more intermediate-term debt?
Yeah, so I think this comes back. There was Morgan, you had a slide before that was called fiscal dominance, and that is very much a view that we have. We have a theme in the portfolio that we manage that we call fiscal dominance. And if you think about the period from kind of 2008 to COVID, monetary policy was a huge driver of what was happening in bond markets. And what has happened more recently is fiscal policy has become a lot more important. You could say fiscal dominance. We also talk about this fiscal monetary entanglement, which is what the question I think here is getting at. There is a real interplay between the two. One really simple example that I like here is, while the Fed has been trying to tamp down growth by raising interest rates, some of the fiscal policy measures that have existed recently have been super supportive of the most interest rate sensitive sectors of the economy. So think about the Inflation Reduction Act, for example, or the CHIPS Act, have put a lot of money into the construction sector. And so while the Federal Reserve is trying to raise interest rates and kind of keep those things down, the Janet Yellen and the Treasury are kind of coming in, and in the fiscal side, the fiscal policy is coming in, and it's actually saying, like, don't worry about those higher rates. We're just going to keep pumping money in. And you see similar things happening with the way that the Fed is trying to approach the yield curve, and then where the Treasury is doing its buying. That all is reflected here in this chart. We estimate, by the way, we've done some work on the back of this that's not shown here, that the impact of this on the 10-year Treasury yield, we quantify that at about 2%. And so what that means is that if this all went away, and if the Fed kind of unwound its balance sheet, that you would see the Treasury rate be at 2 years be 2% higher
than where it is right now, which is a little over 4%.
Correct.
Okay. Wow.
So that's a really big impact on.
That's a big deal
on kind of the shape of the curve. Now,
so for everybody,
suggest that this all unwinds right away, but we think that this is a real driver of where rates are. The other one is fiscal policy, but do you have a question first before we go there?
Well, what I was going to comment on for everybody who's here, and we've talked about this when we do these meetings regularly, the significance of the interest rate on the 10-year Treasury is that's the benchmark for long-term rates. So when we talk about, for instance, mortgage rates, which I'm looking at the guest list, I know quite a few of you are new homeowners. You bought recently on a 3-2-1 buy down or a 2-1 buy down. I see specific people there with the hope or expectation that you're going to be able to refinance to a lower rate when that promotion term ends. And what we're seeing is just the opposite, unfortunately. And this isn't to scare you, but this is one of the things that we at CWM really wanted to hear from BlackRock about, because Fed cut rates by 0.5%, 50 basis points back in mid-September. And now the long-term interest rates, the 10-year Treasury, has gone up in interest rate 0.6%. And now that 30-year fixed mortgage rate is actually creeping up close to 7% again. So that's why we're having this whole conversation. I know it's complex, but the saying is if you want to know what the stock market's going to do, pay attention to what the bond market's doing. And that's essentially what we're talking about here.
Absolutely. Maybe the last thing on policy, and then we can bring it all together with just a few last thoughts. Brian, you commented before about kind of fiscal policy in different countries. Yeah, and Morgan, you shared a lot of insights on fiscal policy and deficit in the US. I think this puts it a little bit in perspective, hopefully. The type of spending that we're seeing in the growth of the deficit right now in the US at 6% is very unusual in a period where you have such a healthy economy and such a healthy GDP. That's the type of spending that you would more likely expect to see in a time of crisis in 2008, in 2020, when the government kind of needed to spend to prop up the economy. And I think that's giving particular concern right here. We're actually seeing something a little different in the UK. And I bring this up in part because what we think is driving the difference in the UK is that a couple of years ago, in about 2 years ago, almost exactly, we had what was called a UK gilt crisis. And so the UK had kind of come out, the government came out with some announcements, a mini budget, some ideas around spending, and the market didn't like it to the extent that it caused for a couple of days major disarray in the UK gilt market. UK gilts are like our US treasuries. It's the government bonds issued by the UK. And you've seen since then a real turnaround in the way that the UK government, even this year, they had an election in the UK, just like we have here in the US. It's rare to see fiscal spending come down in an election year. Generally, people want to run, and we see this in the US, both parties want to run on kind of platforms of spending more. We've seen that turnaround in the UK. Now, how does this all kind of end? What's the end game here in the US? Or how concerning is the deficit? In our view, you don't need to see you don't need to see a UK gilt crisis. You don't need to see a US Treasury crisis. But this is another thing that puts a little bit of potential upward pressure over time on Treasury yields. We are very reliant in the US on foreign lenders. We need people from other countries to buy our bonds. And if you start to think about, if you start to have some concern, even on the margin, about the deficit and about the deficit making that challenging for the US to pay back, you can see that just creep up a little bit in bond yields. You could also see it put some downward pressure on the dollar. So again, it doesn't need to be a crisis, it doesn't need to be emergency. It's really hard to know what kind of puts this more in focus. But we think one thing that could do that is the upcoming US election. It's just putting a lot of focus on fiscal policy, as it does in any year.
You answered it. I was just at a conference last week and I asked that question. I said, we're deficit, almost record level deficit spending, but we don't have the Bank of Japan and the Bank of China and the Federal Reserve, the three biggest buyers of US Treasury bond issuance in the world, buying this stuff right now. In fact, Japan's been a seller, China's been a seller, and the Fed really hasn't been able to buy because of the inflationary concerns. Who's going to soak up all of this?
That's exactly right.
And so you hit the nail on the head, because we've been wondering this for a while. It has to be more attractive rates to attract investors.
Exactly. And again, it could be a big spike. It could be a gradual push up, but it's one of the reasons that we're a little bit more cautious on US Treasuries and a little bit more cautious on on expecting 10-year Treasury rates to come down. We think that the direction is up.
Thank you.
I think we have just a little bit of time, so I might skip ahead a little bit and just talk really quickly about one thing where around the election, which I find to be really interesting. We spend a lot of time, we hear a lot of questions from clients. How are we positioning for the election? Our general view, and Morgan, I like something you said before, it was the kind of the known unknown. We're thinking a lot about fiscal policy, and part of the reason that we're comfortable positioning based on that is that we actually think that regardless of which party wins in the US, we see continued fiscal spending. The two sides want to spend on different stuff, but they both want to spend. Neither has a really credible plan for raising revenue. We think that probably just results in more spending until you see some pressure maybe on the yield curve that puts that more into focus. What we have here, though, and this is part of the reason that we don't try to position, and this relates directly, Morgan, to your chart about the correlation of markets to different parties and different sets of Congress. The red line is showing you over the last 10 years or 70 years on the left and right is what your $100,000 or $1,000 would have grown to if you were invested only for Democrats. The yellow line is showing you if you invested only when Republicans were president, and then the green line is showing you what happens if you just stayed invested along the way. This is just stocks. That's not necessarily a recommendation that we want to be just in stocks, but I think just helps to kind of make really tangible the importance of staying invested. It's really tricky to make calls on elections, and even if you can predict with perfect foresight who will win the election in a couple of weeks, I think it's hard to know when we might find out the outcome of that. But it's also really hard to know what the market reaction might be to that. If you in 2016 kind of knew what would play out, you might have been short stocks, right? There was an expectation that if Trump surprised and won in 2016, that would be really tough for stock markets. That was absolutely wrong. We've seen that play out in around Brexit in the UK, also in 2016, where there was an expectation that Brexit would be really difficult for the UK stock market. It was actually quite resilient. Either party could have stocks up or down, but again, over longer term periods, it generally has mattered much less who is in the White House or in Congress, and much more that you have a plan that you stick with over time, and that you're working with, and that you kind of don't try to time it. Don't be scared of a little bit of volatility around the market. Keep that longer term view.
I was asked, whoever's in the White House, is that going to change you getting up and going to work in the morning? If the answer is no, then it really made no difference, because companies are going to continue going to work, continuing to improve their earnings, continuing to push that share price regardless of who's in power.
My favorite comment on politics is what's going on in your house matters more than what's happening in the White House.
I like that. That's great.
Yeah, it's very true.
Maybe just to bring it all together, look, some of the views that we have to summarize here. The economy appears pretty resilient to us. That doesn't mean that there's not risk in markets. We think that volatility and what we call dispersion, so different stocks, different sectors, different countries, different asset classes, stocks and bonds, different things will happen across that. That's part of the way that we, when we're constructing portfolios, try to capture opportunities. But then I think at the core of that too, diversification remains really critical. It's a core principle. It's really important when stock valuations are high. It's important when stock valuations are low. It's important in election years. It's important in non-election years, but especially important when stock valuations are as high as they are, when there is as much uncertainty around bond markets, and when there is, not just the U.S. election, but broader geopolitical risk. We think diversification at the core of the portfolio and having that plan is super important.
Yeah, completely agree.
Great.
All right. Well, there's a couple more questions in here, but it looks like we're at the end of our time, so we'll go ahead and just reply in the chat to those. Thank you so much, Meghan, for coming today. I really appreciate it.
Yeah,
thank you
so
for
much.
having me.
Yeah. All right. Well, thank you guys.